Hey, welcome back. Getting to episode 5 of the stocks you recommended. A heads up, I included Salesforce in this one even though it wasn't suggested because I think they are in a very interesting spot. As always, if you want me to look into a company, let me know in a few words what attracts you about them. Before we begin, make sure to leave a like and subscribe if you haven't already and check out the other episodes in the series. I can tell you that in every video so far I had 2, maybe 3 companies that I added to my watch list, so maybe this can be useful for you as well. Now Porsche, you definitely know them. They have an interesting history with VW which I recommend you check out. Anyway, just keep in mind that this is not Porsche SE, that's the holding company owned by the family, which also owns 12.5% of this one and a bunch of VW. VW owns 75% of this company and the Qatar Investment Authority has another 2.5%, so 90% is owned by 3 entities. They have a relatively diversified regional distribution, with Europe representing around 41% of the deliveries. Still, issues in China, which was about a third of the revenue source, are a main factor behind the stock not doing so well. A year ago, they made around 1.9 billion euros in cash flow, placing them at a ratio of around 30, which is pretty normal for the high-end producers. Luxury brands should be much more resilient to economic issues like a recession. Looking at Ferrari, for example, they didn't even move during the pandemic, while companies like VW crashed like 50% in less than a month. Comparing them even further to Ferrari, it's interesting that the latter is valued at like 70 billion while making half of the money that Porsche did. Sure, a Ferrari is less accessible and usually more expensive, but investing is ultimately about money. I don't see a difference in growth potential that would justify this disparity. If anything, by being more accessible, Porsche should have more room to grow. Overall, pretty good margins, which is what you can expect from a luxury manufacturer. 25% EBITDA and 10% cash flow, not bad. They had some issues in Q1 due to a low product availability, resulting in a relatively high impact of fixed costs. I know they had some issues with VW's tech, which probably resulted in this kind of problems. But they have a strong order book and see improvements in the availability of the newer models, so things might improve throughout the year. Financially, they are in a good position, with the current assets covering the current liabilities and a good chunk of the non-current ones. Looking again at Ferrari, that's a very tiny company. Good financial shape as well, yeah, but 3.3 billion in equity on a 70 billion market cap is terrible. Sure, the value of the brand is huge, but again, do you invest for the brand or the money they can make? Now, like any other car producer, they depend on the economy, even if they sell luxury products. Maybe they won't crash 60-80% like the others, but you can never know. The upside, however, from a boost in the economy should be pretty good. So this one really depends on who you compare them with. I think Ferrari is an exaggeration from the market, let's be honest. On the other hand, they are at a ratio of like 6 times more than Stellantis, so isn't that a lot? You know, it's an okay company, but I think this is a very high price for what they offer. If the issues with China and the availability are over, they can definitely do better, so there is potential. Now, Salesforce, this is a tech company providing CRM or customer relationship management software and other apps for marketing, e-commerce, analytics and more. They developed a lot lately and a bunch of big companies are now using their software. They recently published the Q1 report and the market really didn't like it. Everything was up in the 7, 8, 10% area or even 43% if you look at the cash flow. They also talked about AI and at this point it's a classic thing to do. Still, it has potential, so we'll see how it goes. Now, despite a very good improvement in the cash flow and overall a strong quarter, the stock fell 20% because the market expected more. If you look at the reasons behind the crash, it's a very good representation of the market. So, the company has been improving, but Q1 sales missed estimates and they offer weaker than expected guidance in Q2. And that's enough for every so-called analyst to lower the price target and influence the market. And this is a classic issue with this kind of company. We can see a similar swing in investor confidence a couple of years ago with all the big tech like Meta, Alphabet and the rest. People buy thinking they can deliver 20, 30, 40% growth every year, but when reality hits, even if just for a year or two, this investor confidence can fade really fast. But on the other hand, this kind of shorter-minded people selling can make room for value investors. I don't think they are a value pick right now, but if they continue to grow the cash flow even at 10% per year and the stock keeps falling, they can offer a lot of potential. The cash flow has been improving very well and they expect a nice operating margin. Currently, for a market cap of around 200 billion, they are at a ratio of around 20. However, this year they might even make as much as 14-15 billion, placing them at a much more attractive ratio. That can open the potential for a nice dividend or some big investments, so it's definitely something to pay attention to. You know, even half of that is a 3.75% dividend, and if they continue to fall, that can easily get to 4-5%. Or they can continue doing buybacks, maintain a high valuation, and use it to buy other companies like Amazon, Google, and the rest do. So they are getting to a spot where they potentially make enough to get into this kind of a dominant position, which can really snowball as we saw many times before. But you know, the market will keep focusing on the short term, opening this kind of potential opportunities. Financially, they are in a pretty good position, with the current assets covering the current liabilities and overall not a lot of debt. They have a lot of goodwill though, so you don't really have a lot of assets, but it's pretty normal for a tech company. You know, they don't need some billion-dollar factory to offer a service. They pay pretty high stock-based compensation, which again is a two-sided thing. It motivates the employees to think about the business, but it also incentivizes them to deliver good results in the short term, and we saw how much those matter recently, which may not be the best for the company. I can tell you from experience that when every manager is like, we must grow now, instead of thinking about the long term, things can get really bad. They pay a small 0.7% dividend, but they do pretty significant buybacks. They were probably a reason behind the stock going up so much since late 2022, but now may not be the best time to do it. Still, they probably have to do it because of the stock-based compensation. That's the company's first ever dividend, by the way. It's about 1.5 billion per year, so there is definitely potential for more if they want to focus on that. I work with some of the reps and indeed they offer some of the best and most popular options on the market. You know, even if they are slowing down, they are getting very interesting from a cash flow perspective. If they can make, let's say 15 billion per year, they are at a ratio of around 13 today, which is generally very low for such a tech company. I think this might have potential of turning from a speculative growth bet into a solid value investment. It's not there yet, but as people who bought thinking they can grow very fast forever are selling, they are entering into a very interesting territory. You know, at 15 billion per year, they could easily pay a 3-4% dividend plus buybacks and still have money to develop. But until then, I'm definitely going to add them to my watch list. Now, Lovesac, they offer mid-luxury furniture. They have a market share of about 1%, but what's interesting is that they offer some immersive speakers and chargers, and this kind of modularity can generate a higher customer lifetime value. They actually focus on that, and almost half of the transactions come from already existing customers. They had a pretty good increase in new clients, so that definitely has potential to generate even more in the future, then reinvest it into reaching new people and so on. They reported an okay year with a record in sales but a lower net income. We can see them improving on the operating cash flow level, which is definitely a good thing. This year they see an even lower net income, but a majority of that is due to a loss in Q1. They opened over 40 showrooms again, so that definitely has an impact, and we can also see higher depreciation expenses. They reported about 47 billion in cash flows, which would put them at a ratio below 10, but that's not a reliable number. If we keep seeing this kind of cash flows or even improving ones for 2-3 more years, then it's definitely attractive. They are still in a development phase, so the cash flow will probably be very volatile. Financially, they are in a very good position, with the current assets almost covering the total liabilities and zero debt. That puts them in a position where they don't depend on the market and interest rates. Thanks to that, in the future, when the rates are lower, they can unlock a lot of growth. Even 100 million in debt would be the equivalent of 3 to 4 years of capex at the current rate, so it can definitely do a lot for the company. The equity is about half of the market cap, so not really the best, but also not terrible. The problem is, with this kind of company in general, there is no competitive advantage. You can have amazing products, but then there is the issue of price and the limited volume you can sell. If you don't have some amazing products, someone in China or in South America can probably do it cheaper, including the shipping. Even recently, we saw Leggett & Platt, a former dividend king, having to cut the dividend as an example. Even if you have better quality, the competition can really destroy the margins, and if you commit to some high dividend or a lot of debt, that can have very bad consequences. But on the other hand, rate cuts can lead to more consumer spending, meaning that a company like this can have a lot to gain. So it's really something you have to balance. The pandemic boom with all the stay-at-home hype was probably not reasonable, but if they manage to grow, there is potential to see maybe a 2-3x in enough time. It's not a bad company, it actually has very good financials, but you have to be aware of the potential risk. They depend a lot on the economy, meaning that they can benefit from an increase, but they are playing in a very competitive market. And another thing with potential is finding another big retailer. If they get a deal with Walmart or something similar, for example, that can easily even double the sales. So at any point, especially if they keep growing the brand awareness, we could see such an announcement. That would have a huge impact on the stock price. And there is also potential to grow internationally, but I think they are far from that level right now. Overall, this is a pretty good company. They definitely have potential to grow and keep generating a lot of lifetime value from the customers. When we see rate cuts, that can create more demand and it would also allow them to get some debt and then the growth would really begin. If I can see them in the 15-20 area to basically get them at a price to book value of 1 just to be more careful, they can definitely be okay. They were at this level even a couple of months ago, so it's not impossible to see. And finally, American Lithium. They are a project developer with 2 lithium projects in an advanced state in the US and Peru, plus the 5th largest undeveloped uranium deposit. As we saw with other similar companies in previous lithium videos, you buy this kind of company as a bet on the potential future of the projects. They don't produce anything, so any kind of disruption or delay or barrier can result in a lot of trouble. These projects are far from producing, and I mean half a decade or even more in some cases. The American project isn't that attractive because they see a production cost of almost 7,500 in stage 1. You know, it's okay with lithium at 15, 20, 30,000, but what if it drops to 10 or 6,000? And another thing, if they see 7,500 now, by the time they finish it, you have to assume a margin of safety and say 8,500 or even 9,000 because you can never know what can happen. Even 7,500 is expensive, so you know others in the region see even 4,500 or 5,000. The life of mine should be okay at 40 years and they see about 38,000 tons in average production, so it isn't huge. Still, having it in the US has in itself potential. This is in Nevada where you have a bunch of similar projects and even one of Tesla's factories nearby. You know, all the Inflation Reduction Act and Made in America and potential tariffs, politics and so on. The Peruvian project is a bit better, but that's normal in the region. Of course, it has a much lower production cost, but also a lot of potential to scale the production. It's also great that this one would produce already battery-grade lithium without having to refine it for about 30 years. The life of mine should also be above 40 years, which I'd say is normal from what I saw. Financially, they are in an excellent position, with the cash alone being almost 3 times above all the liabilities. Currently, with about 170 million in equity, they are at a price-to-book value of around 1, which isn't terrible, but you rely on the evaluation that they present. You know, in every presentation, they assume the price of lithium at 20,000, but if there are issues and they have to sell something, lithium probably won't be at 20,000. You know, at 5,000 for example, they might not even be able to sell the projects because everyone in the industry would have issues and the few that can be picky would have much better options to choose from. Then the value of the assets might be a lot lower. Again, they don't really produce anything now, but this can rapidly change. They need over 1.5 billion in initial capex for the 2 lithium projects, and that will probably have to be funded by debt, issuing shares, partnering with another company, and so on. There is potential to see some car company buy a stake in them like it usually happens to secure some production, so keep that in mind. That can basically guarantee a significant amount of the funding needed, but if it doesn't happen, securing the capital can be very difficult. Again, they aren't producing anything, so to get money, the main options are issuing shares or getting some debt. They need up to $1 billion for the American project alone, so it won't be simple. And imagine that by the time they finish it, lithium is at 5,000 and they produce at 8. That's probably bankruptcy if something doesn't happen. They can sell one of the projects, but the value probably isn't huge at the moment because the company itself is worth like 200 million or less. To be fair, they have interesting assets, but it's a very risky investment. I prefer companies that already produce even a bit and have potential to expand even more. I think Arcadium, which I talked about before, is a better option than this. But it's also about the risk and reward level you want to take. If everything goes well, this can easily be a 10, 20, 30x or even more. But developing these projects can take even over a decade, and in that time a lot can happen, from new discoveries that would replace lithium demand or politics, recessions and so on. So if I were to get something like this, it would be a very small position. You know, if it's gone whatever, if it's a 20x, then it can be very significant. So once again, a couple of potential buys at the right price. I like this kind of diversity in the stuff that you recommend because that way we get to learn about even more industries. Again, if you have a suggestion, please let me know what's interesting about them in a comment below. And if you like something and want me to cover them again in the future, make sure to let me know. So far, I added some good companies to my watch list, so make sure to check out the other episodes in the series as well. Keep in mind that these are just some quick stock reviews and there are definitely things that I missed. I actually encourage you to point out anything you see wrong or missing in what I say because that way you can help us better understand these companies. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.